In just 12 months, silver exploded 127%, platinum surged 120%, and gold crushed expectations with a 65% gain. These aren't normal market moves, this is generational volatility. And now, as we head into 2026, a critical divide is opening up between what retail investors believe and what Wall Street insiders are quietly positioning for. More than half of Main Street is betting silver will repeat as the top-performing metal, but some of the biggest commodity desks on the planet say the real winner hasn't even made headlines yet. This is where the tension begins. Retail traders are crowding into silver after a historic run, driven by FOMO, and a belief that lightning can strike twice. Meanwhile, institutions are scanning balance sheets, vault inventories, and macro data, and many of them are rotating into something far less crowded: platinum and palladium. When retail and institutions diverge this sharply, someone is usually about to be very wrong. According to the Kitco Top Metals 2026 survey, based on 352 retail investors, a clear majority, 51 or 178 traders, expect silver to outperform all other metals again next year. Another 29% are backing gold, only 10% picked platinum, and 11% chose copper. That's a powerful signal of crowd psychology. Silver has become the hero of the retail narrative, but crowded trades often carry hidden risks, especially after parabolic gains. But here's the problem: markets don't reward popularity, they reward imbalance, and silver's balance just shifted dramatically. TD Securities dropped a bombshell that most retail traders completely missed. While everyone was chanting shortage, the silver market experienced the largest replenishment of LBMA free-floating inventories on record. Over 212 million ounces of silver are now freely available in London vaults. Let that sink in. That single inventory wave covers nearly 2 years of global silver deficits. In other words, the squeeze turned into a flood. Think of silver like a coiled spring. During the squeeze, prices had to rise to force metal out of private vaults and scrap flows. But TD says we've now hit the strike price, the level where supply automatically comes back online. Once that happens, price loses its upward pressure, the spring uncoils, and suddenly, silver doesn't need to rise to attract metal anymore. TD Securities expects silver to start 2026 in decline, projecting prices in the mid-40s per ounce. That is not a crash, but it is a sharp contrast to the explosive upside most retail traders are expecting. This is where behavioral traps kick in, anchoring to past highs, ignoring new data, and assuming momentum is permanent. Gold, meanwhile, is playing a very different game. TD sees no rout, no collapse, just a continuation of a structural bull market fueled by currency debasement, rate cuts, and political pressure on the Federal Reserve. Here's why that matters. TD expects the Fed to cut another 100 basis points, with some markets pricing in 150 BPS, even while inflation stays above target. That's negative real rates territory. Historically, that's rocket fuel for gold. Add in record U.S. debt, a weakening labor market, and rising doubts about Fed independence, and gold becomes the financial system's insurance policy. But the real twist in this story, the one most headlines are missing, is platinum. TD Securities has named platinum and palladium their top commodity picks for 2026, forecasting prices roughly 20% higher than current market consensus. This is a classic contrarian setup: tight supply, misunderstood demand, and almost no retail participation. TD points to de-urbanization trends, continued stockpiling, and tightening forward markets. They're expecting higher lease rates, tighter availability, and rising prices. Platinum isn't driven by hype, it's driven by industrial necessity, substitution effects, and supply constraints. When lease rates rise, it's the market screaming that physical metal is scarce. Not everyone is pounding the table yet. Securities analysts warn that after such massive rallies in 2025, metals could enter a consolidation phase in early 2026. They argue prices went too high, too fast, and history supports that caution. Even bull markets need to breathe. Sideways movement shakes out weak hands before the next leg higher. Securities also raises a darker possibility: recession. The U.S. yield curve uninverted over a year ago, and the job market is weakening. If a recession hits in 2026, PGM prices could temporarily trend lower. This is where psychology matters. Volatility doesn't invalidate the thesis, it tests conviction. Securities projects gold between $3,750 and $5,000, silver between $43 and $62, and platinum in a wide $1,300 to $1,800 range for 2026. Wide ranges mean opportunity, but only for investors who understand cycles, not headlines. So here's the real question: will retail investors chase yesterday's winner, or position early for tomorrow's? History shows the biggest gains come when conviction is low and fundamentals are tightening. If you found this breakdown valuable, hit like, subscribe, and share this with someone still stuck in the silver echo chamber. And let me know in the comments which metal are you betting on for 2026 and why. Because in markets like these, being early isn't luck, it's strategy.